Welcome to episode 2 of the Kiwi DIY Investor. In this episode, we'll be looking at the difference between the NZX and the ASX. This will be your initial stock universe of companies that you're able to invest in when you first open a brokerage account in New Zealand. First off, a disclaimer. The video is for informational purposes only and doesn't constitute financial advice. If you're unsure, please contact a registered financial advisor. And I may have positions in some of the stocks mentioned in this video series. So most New Zealand brokers allow you to invest in companies listed on both the NZ Securities Exchange, the NZX, and the Australian Securities Exchange, the ASX. Why not other international markets? That's a good question. A lot of people would want to invest in Tesla, Google, Facebook, which are listed in the USA. But many New Zealand brokers do offer this service, but it's expensive and in terms of both brokerage, and they charge you a custodial fee for the amount you've invested at the end of each year. Future videos, I'll look at ways of getting exposure to international markets from New Zealand in a more effective way. And there's also additional tax considerations for investing outside Australasia. So comparisons of the NZX and the ASX. The NZX has about 170 companies listed. There's no currency risk for Kiwis. So what I mean by that is I'm earning New Zealand dollars. I have most of my savings in New Zealand dollars, and the company's share price will be listed in New Zealand dollars. So there's no risk there of a currency going the other way and eroding your gains. Kiwis are eligible for imputation credits on dividends if available, and I'll go into that in a future episode, what that means. And you get your dividends via direct debit, which is very convenient. Compare that with the ASX, which has over 2,000 companies listed and allows you to get exposure to industries that don't really exist on the NZX, like big mining companies and oil and gas companies. There's greater liquidity. What do I mean by that? Well, there's a lot more people trading and investing on the Australian Stock Exchange. The volume of transactions is much higher, even if you were to extrapolate the size of the New Zealand population to the Australian population. The difference is much, much bigger than that. And that allows less risk of you getting stuck with a share if no one wants to buy it, even at the small end of town. There's usually lots of volume going through, so that means that you'll usually find a buyer pretty close to where you want to sell. There's currency risk if you're a Kiwi and you're investing on the Australian exchange. So I earn New Zealand dollars and my savings are New Zealand dollars, but I'll be buying shares quoted in Australian dollars. So what that means is, say the share price of the share I've invested on the ASX goes up 10%, but the New Zealand dollar moves up 10%, then that gain will effectively be wiped off if I sell and translate the money back to New Zealand dollars. This can also move the other way. So for example, if I invested in an Australian share and it went up 10%, and the Kiwi dollar fell versus the AUD, so the Australian dollar was even more valuable against the New Zealand dollar. When I sold it and I translated the money back to NZD, I'd get a double bonus, so 10% currency gain and 10% share price gain. So it can move in any direction, but it's just an additional risk you'll be faced with. Non-Australians don't get benefits of franking credits on dividends. So franking credits is very similar to New Zealand's imputation credit regime, and I'll go into that in future episodes. And dividends often come in annoying foreign currency checks, which mean you have to physically go to the bank to bank them and give ID and stuff like that. A lot of companies in Australia don't do direct debits to Kiwi shareholders. So, conclusion, I think it's best to look at both exchanges. Both have exciting stocks run by some strong management teams. Investing in both exchanges allows access to a greater variety of companies, and that gives you better diversification. The access to imputation credits or lack thereof means that there's a benefit for getting dividends from New Zealand companies. So if you're a dividend-focused investor, you're better off probably focusing more on the NZX. And we'll go into that in a future video. So that's all on the NZX versus the ASX. Hope you found it enjoyable. If you've got any questions, put them in the comment section below. Thank you.